Hey everyone, welcome to another episode of Finance Simplified, the official podcast for Street Fins. We're here to break down the world of finance for you to understand from a relatable perspective with discussions with experts. This is episode 9, and if you listened to our last episode, you'll know that we had our first co-host. This episode is going to continue that trend, as I have another co-host with me today, and that co-host is Alex Patel. Alex, would you like to introduce yourself?
Hey Rohan, glad to be here. I'm Alex and I'm an incoming freshman at Stanford, as well as a co-founder of Street Fins.
So Alex, you're smart, you're going to Stanford. What are you looking forward to most there?
Well, Rohan, I'm in the heart of Silicon Valley, around the home of many startups, and I think the entrepreneurial spirit is something that really runs through Stanford, whether it's through the faculty or the students who are all pursuing entrepreneurial ventures. Combine that with a university atmosphere, and I think Stanford is the place to be. Now, Rohan, you're headed to USC. Can you tell me a little bit about the entrepreneurial atmosphere there?
Yeah, it's grown quite a bit in the last few years, and especially with the business school Marshall and the new dean they got from Wharton. All I can say is that I'm really excited to be part of this growing community of USC entrepreneurs there, which is kind of a perfect segue into what our topic of our episode is today. Because Alex, the focus of today's episode is the dot-com bubble of the late 90s and early 2000s. Now, why are we going back in time to look at an event that transpired close to 2 decades ago?
Well, Rohan, just take a look at the stock market, specifically the tech sector, during the COVID-19 crisis. Tech stocks are on a tear right now, reaching levels near all-time highs. Well, as of the day we are recording this, July 18th, tech stocks had a rough week, with the Nasdaq down 2% for the week. Interestingly, the index has still risen to a higher price compared to what it was before COVID drove the market down in March.
Exactly. Tech has been unstoppable, but it was also regarded as unstoppable back in the 90s, which led to the period we now know today as the dot-com bubble. Our guest today had a lot of experience in tech, especially in the 80s and 90s. She has the holy trinity of experiences in tech. What all did she do, Alex?
Well, first, she started out as a tech entrepreneur in the 80s. Then, she worked for a large tech company in a senior role. After that, she became a venture capitalist. She has a diverse range of knowledge that will help us undoubtedly learn about the dot-com bubble. She will help us understand the lead up to the bubble, what all was going on in the tech world, the bubble bursting, the relationship to today's markets, and her experience promoting entrepreneurship, as well as lessons for investors.
It should be an eye-opening conversation to say the least, revealing the all too fallible characteristics of markets and cautionary tales of excess and hype. So, let's just get to simplifying. From the minds of the students at Street Fins, this is Finance Simplified, the podcast that simplifies the seemingly complex and confusing world of money. I'm your host, Rohan Gupta. If you've been paying attention to the stock market in the past few months, you've probably been watching a lot more stories about tech stocks going up and hearing people say things like this.
The surge in big tech stocks.
The Nasdaq trading near its record high.
Warning that tech stocks are in a bubble.
Our guest today is Heidi Roizen, and she's a partner at Threshold Ventures. She's got a ton of experience in tech, especially during the time of the dot-com bubble. Her career is so impressive that I think I'll just let her introduce herself.
Thanks for having me. It's a pleasure to be here with both of you. My name's Heidi Roizen. I'm a venture capitalist, and I've been doing that for a long time, about 20 years. And before that, I was on the other side of the fence as an operating CEO. I started a software company with my brother about 20 years before that. So I've been doing this a very long time. I am on 6 boards, so I'm a member of board of directors. 4 of the companies are Threshold Venture portfolio companies, and 2 of them are public companies. A company called DMGT, which you may not have ever heard of, but when I tell you they own the Daily Mail, most people have seen the Daily Mail or Mail Online, the British newspaper. And another company called Invitation Homes, which is in the home rental space in America. So those are the public companies I work with. The private companies I work with include Polarr, the photo editing company, Zoox, the autonomous vehicle company that is just in the process of being acquired by Amazon, Memphis Meats, which is creating cell-based meats so we can all eat meat without killing animals, and Planet, the largest constellation of satellites ever launched. We have over 200 satellites in the sky, and we image the entire Earth landmass every day. So those are all the companies I'm involved with. And basically, I spend most of my time talking to the people at those companies and seeing how I can help them move the ball forward, especially in these unusual times we have right now.
I'll hand it off now to my co-host, Alex, who will help give us some historical background on the history of the internet and the dot-com era.
So I think the topic of this podcast is understanding the dot-com bubble. And so I think we should start with understanding the internet. So Heidi, could you walk us through kind of the brief history of the internet, who founded it, and what was the timeline of some of the main
I'm not
events
sure
and
I can.
founding?
I'm not sure that I could do justice to the history of the internet. But let me give you a little perspective as to the dawn of the internet in terms of it being of commercial use. So I'll give it from a very personal perspective. I was running a software company called Teamaker. Started it in the 80s and was running it in the 90s. And we were selling something called click art, which was digital imagery for use on newsletters and things like that. And I remember my first thoughts about the internet came in two ways. One is we started using it to communicate. I mean, I know it's hard for everybody of this generation to remember that there used to be a time before digital messaging, email, all that kind of stuff. And really the dawn of that was applications like something called Prodigy, something people are more familiar with, America Online. Those were the first instances where you could actually have email and mailboxes and start using the internet for something as practical as communications. We then started seeing in the mid 90s with the advent of things like Netscape, the browser, right? And the browser was this incredible thing that all of a sudden you could go and look at a web page and go look at something that someone else put up on their computer. Before that, computers were very isolated creatures. They each sat on your desktop, and maybe internally in a company you would have email, but this idea that you could reach out to anyone or share information was pretty nascent up until the mid 90s. And then it really started to take the world by storm to the point where by about 2000, it was really clear that the connected world, the connected device was really the future of many things. I think we started to see it was going to be the future of communication. It was going to be the future of collaboration. It was going to be the future of entertainment, all sorts of things, and really took off from there. And so that is when I ended up selling my company. And I actually was VP of Worldwide Developer Relations at Apple, just at the time that the internet was sort of taking off. And actually, interestingly, at the time, while Apple was only about 5% of the installed base of computers, it was 25% of the installed base of people who were on the internet, and it was 50% of the webmasters on the internet. So the Macintosh had a really, really significant and early impact on the web. And then I became a venture capitalist. I really saw the opportunity that there would be a whole lot of new companies forming. You have to remember around this time, that was the early days of things like Amazon. So, I would really say that was kind of the timeline. And I think if you look at the timeline of the evolution, we're still evolving. We're still evolving with mobile, and we're still evolving now with all sorts of other devices that may not have a typical computer-like interface. And so I think especially nowadays in the era of COVID, the internet and connectivity has become so fundamental to so much of what we do that I think people would sooner go without water than they'd go without their connectivity. So it has become something incredibly essential.
Simply put, the early days of the internet showed the world that the internet was here to revolutionize communications and connectivity. Many companies formed back then to try and deliver on these promises, and they had to compete with larger companies at the time. Now, you mentioned companies like Prodigy and Netscape, but these are generally smaller companies compared to incumbents like Apple and Microsoft. How were these bigger tech giants threatened by these smaller companies, and what was that atmosphere in the 80s and 90s?
This is history that repeats itself over and over and over again. Generally, large companies, they have what they call the legacy problem. And the legacy problem is you start a startup and you grow it and you grow it and you grow it. And over years, you build relationships with customers and you build whatever it is the customers are using. And then some other new startup comes along that's trying to do the next generation of what you do. But the problem is you have legacy. You have existing customers that know how to do things a certain way. They don't necessarily want to change platforms. They want to make use of what it is you've already sold them. They want you to support them. And so, I think a lot of times in technology, particularly, disruption comes from those startups. Now, at the same time, a lot of these companies that you just mentioned, I would say Microsoft and Apple and Google and the big ones, right? They also have something that little startups don't have. They have a lot of time and they have a lot of money and they have a lot of people, right? They have a lot of resources. And with resources, you can learn from those small startups. You can eventually compete. You can acquire those small startups. Again, if you look at things like, for example, if you look at Android, for example, and you think about Android and the Android platform, in essence, the Google platform for operating systems, those were acquired products. If you look at Apple and you think about Apple's music, iTunes, those sorts of endeavors, that was a little startup that got acquired, right? That was not something invented inside Apple. So I think if you look around, and if you look at, for example, I just talked about the fact that Zoox, one of the leading early players in autonomous vehicles, has just been acquired by Amazon. So, we haven't even shipped a product yet at Zoox. That will ultimately, the day it ships, it'll be an Amazon product. So I think that the big companies have an advantage, obviously, in their reach, their resources, and all of that. But I still think startups have a lot of advantages in these changes in the world because they don't have legacy to worry about. They don't have to spend a lot of time thinking about the old customers. They can really focus only on the new customers.
So the way that larger companies dealt with the legacy problem and with disruption from smaller startups was either to utilize their existing resources to compete with smaller companies with fewer resources, or simply by buying them out and rebranding their technology. Heidi gave some modern day examples, but we actually did the math for the top 7 tech companies during the 90s and early 2000s to see how their acquisitions stacked up. It turns out that the top 7 biggest tech companies from 1994 to 2002, Apple, Microsoft, Cisco, IBM, Intel, Oracle, and Amazon, spent, at a minimum estimate, about $62.5 billion acquiring new companies. This only counts the acquisitions they made public, as there were many acquisitions made for an undisclosed amount. The R&D they did back then for the same time period totaled around $118 billion. This means they spent a little bit over half of what they spent on R&D on acquiring new companies and their technologies. This means that in addition to their cost of research and development, these companies spent significant sums to buy new companies and startups. A lot of the R&D these companies did was with their newly acquired technology from startups as well. It was clear that companies wanted to get a piece of the internet and its promise, and they weren't going to let the smaller and more nimble startups of the time take all the glory. Now over to Rohan, who will get into the lead up to the bubble.
Thanks, Alex. So we've established that the internet was this new invention that everyone wanted to get a piece of, ranging from consumers to startups to big tech companies to venture capitalists. There were commercial usages of the internet as well as constant innovation. But, as we now know in retrospect, all this created conditions that led to a bubble, as Heidi explains further.
If you go back to the late 90s and you think about what was happening is there was the people who understood that the internet was going to present this great opportunity for connectivity, right? And I can't remember the name of the person who said this. He said, the future's already here. It's just unevenly distributed. And when I think about it that way, the people who were already using technology, already understanding the World Wide Web and connectivity and buying online and the believers, right? They started investing and there was a lot of money available. It was a good economic time and there was a lot of investment going into this next generation. What was that going to look like? I think it's very common, and the dot-com boom was no different than this, that because the future is unevenly distributed, people who are already comfortable with that technology sometimes get ahead of themselves and believe that, everybody's going to go buy a computer to do this, because remember, this is really sort of pre-mobile device. This is really, you're talking about desktops being the primary point of access for the internet. People thought that people were going to be more comfortable entering their credit cards into things than perhaps people were. We didn't have the kind of infrastructure for distribution and all the things that we have now. And so I think there were some great ideas. And again, if you go back and look at 2000 and you look at early Amazon and you look at things like Webvan, which was early food delivery, there were a number of companies that today actually you can look around and see currently successful companies that probably the business models or the pitches didn't look that different. But back in 1999, they were being pitched on the promise of, if you build it, they will come and all these users will be there and users will have adoption and people will have technology and it'll be easy to get on the net. And again, most homes didn't have broadband at the time. In fact, basically no homes had broadband at the time. So the whole infrastructure and the whole ecosystem wasn't there to fully support these very correct visions of a lot of the entrepreneurs. But the entrepreneurs and the investors believed in those visions. And when the economics weren't there on some of these things, you found people starting to justify their valuations by talking about things like eyeballs and stickiness. Those were sticky eyeballs, which sounds super gross today. When you think about that, it's how many people can I attract and how long will they stay on my platform, because someday I'll be able to monetize them. But it turned out that, again, the idea that back in 1999 that you were going to monetize things through advertising when there wasn't a whole platform for advertising, advertisers weren't accustomed to it. The infrastructure for how you would account for that advertising didn't exist. And so I think that what happened is just these companies got ahead of themselves. They weren't able to ultimately monetize being internet companies because the whole infrastructure was not there. It was not the whole end-to-end system. And it's an important lesson learned, which is if you build 95% of what a customer needs to be successful, but you don't build that last 5%, the customers are usually not going to meet you, not halfway. They're not even going to meet you 5% of the way unless your product is so essential to their being that they'll do that. And that's just usually not the case. And so companies got super, super highly valued. There was this frenzy about the internet was the next great thing, which wasn't wrong. But the economics, the equity wasn't valued. A company would go public at $1 billion valuation that only had 10 million in revenue and was highly unprofitable. And people believed in that, believed that in essence, you would grow into that valuation. But then for whatever reasons, and there's all sorts of reasons why people believe this, but just at a certain point, the market turned and investors no longer believed that these were ultimately going to play out. And a lot of the stocks really tumbled. A lot of companies were not viable because they weren't profitable. And so if you're not a profitable company, you can't get to profitability and you can't raise more money, you are going to be a dead company. A lot of companies die. But then again, if you look at some of the fundamental companies, I think the poster child of all companies founded in that era is Amazon, which is now, depending on what day you look at it, it's the most valuable company on earth. It had the staying power to stay through. I think they made a lot of smart decisions around how they expanded their lines of business. And, some companies ended up coming through the dot-com bust and surviving.
We touched on several ideas just now, including the idea of companies chasing growth over profits, as well as just the sheer amount of capital available during these generous capital conditions back then. Some of these generous capital conditions included low interest rates, which allowed people and firms to borrow money more cheaply, several government acts that promoted economic growth, and just a huge demand for investing in internet companies by the venture capital industry. As these internet startups got funded and grew, they needed to turn to the public markets to get serious and have an opportunity to expand even more. That's where investment banks come in. Could you go more into what investment banks were doing? Because we've sort of explored the entrepreneurial side and the venture side, but in regards to IPOs and investment banks, could you explain how they sort of fed into this frenzy?
Sure. Well, investment banks are part of the ecosystem of, full life cycle financing for companies, right? And so investment banks exist to help take companies, either to sell companies or to help take them from private to public. And when you're taking a company from private to public, you're going out and going after a different class of investor. You're going from the private equity investor, first it's a venture capital investor, then it's private equity investor. Those are trained professionals like myself who this is what we do for a living. And ultimately you're going public. And the whole point of public is that you then expose this equity to the individual investor. And so I think there was a lot of hype and frenzy around the idea that the people who were making the most money off the internet were these very fortunate, highly trained venture capitalists and private equity people. And there's always a desire to democratize these investments and have them go over a broader population, over retail investors, over the consumer investor. I think the problem with that was that ultimately the fundamentals of these businesses were not yet proven out. And yet there was appetite for this. You can't really look back and say, well, who was to blame for the dot-com bust? Believe me, there was a lot of finger pointing and a lot of blame. A lot of money was made and then a lot of money was lost. And when money gets lost, people look for people to blame. But, there's a whole system in place. And I would argue that whole system is still in place. Like if you look at what's going on right now with the run-up of Tesla and all the retail investors investing in Tesla and look at its market cap compared to its revenues, I don't know how to make business sense of Tesla's valuation at this time. I could be right or I could be wrong, but there are usually rules of thumb about earnings per share and growth rates and things like that professional investors in public markets, which by the way, I'm not, but a public market professional investor looks at all sorts of ratios and things and tries to figure out, what is the right value of this stock. which again, for anyone who went to business school, it's the value of an equity is the discounted cash flow of all its future cash flow, right? That's sort of the standard textbook answer. And so they're, by definition, almost companies that aren't profitable would have no value. It's what their future value is going to be, is what their future cash flow is going to be. So those are all speculation. So, the bankers played their role. Bankers take companies public. There is a buyer on the other side of that who's buying the equity. And, I sometimes look back and think we were all in this massive belief bubble that said that these companies would ultimately find their business models and grow into these valuations. But for many of the companies, it never happened.
Yeah, and I guess one of the things that was driving this huge belief bubble, as you put it, this massive hype, this massive frenzy, was really like these internet evangelists. So I'm curious, you were the vice president of worldwide sales at Apple in 1999. I think that was your position, right?
Worldwide developer relations, not
worldwide developer relations. My bad. But even then, you must have been encountering a lot of, young internet entrepreneurs that may have been just considered evangelists. So could you describe some of your experiences with these so-called evangelists?
Sure. And I think evangelism was an interesting term. I think it was actually coined by Apple before my time by Guy Kawasaki, if you've ever read any of his books.
Yeah.
So I think the term originated with Guy's tenure. Guy was there before me. I came there in the late 90s. The evangelism group actually got formed, I want to say, in the early 80s for the Macintosh. I think that was, because they realized it was this nascent new system. It was a whole different way of thinking of things, the graphical user interface, as opposed to the old CPM and MS-DOS systems. And so evangelists were people who would go out to developers and developer companies like mine and would try to convince you that you should move your software onto their platform because ultimately, it was going to be a better business, right? You were going to be able to do something that you couldn't have done on the old systems, and Apple was going to support you in such a way that they were going to help you promote your software, and you were going to sell your software, and you were going to make money and grow your business. When you think about the role of an evangelist, and I think sometimes that role evolved, and depending on the market and depending on who was running it, I know when I got to Apple, one of my complaints about Apple was I felt that evangelism had become this sort of shoving technology down your throat mission, right? Which was the idea is like Apple had all these technologies and we were trying to convince the developers of the superiority of our technology. And my having come to Apple as a former CEO of a Mac software company was to bring my own reasoning about this, which is at the end of the day, these are business decisions, not technical decisions. And yes, while some people fall in love with the technology and then they manifest that technology in some sort of application, and once in a while those end up hitting a sweet spot and taking off, at the end of the day, software development is a business for most of us. And so what I brought to Apple at the time was, I would call it more of a business discipline around the idea that evangelizing wasn't just about evangelizing how awesome the technology was. It was about evangelizing how you could create a viable business by supporting that platform.
The takeaway here is that most evangelists fell into two categories, the ones that hyped up new technology and the ones that hyped up new business ideas. We've established that there was a mass hysteria that formed around internet companies that pervaded throughout the tech and finance communities in Silicon Valley and Wall Street. But eventually, the bubble popped. I'll hand it back off to Alex, who will go into the bubble popping and its effects.
Thanks, Rohan. So early 2000s, specifically February through March, there's a series of events that happen. Greenspan raises interest rates, Japan goes into a recession, Yahoo and eBay fail to merge. Microsoft was also found guilty of monopolistic practices. Investors were getting uneasy. So was this an inflection point for the markets?
In the time, 97, 98, 99, leading up to this, there was a lot of innovation. There was a lot of change. There were a lot of things that were indicative of what has now become, again, looking in the rearview mirror, it's easy to see how foundational and important the internet was, right? And .coms, as they were called, were internet-based businesses. But the valuations got ahead of the reality of the business models. And as I said a little while ago, you either have to make money or you have to raise money to stay in business, right? I mean, you got to pay your payroll somehow. You're either making revenue or you're selling equity. And so I think what happened in early 2000, and again, you were seeing these companies go public and they were having these massive valuations. And so they were able to get basically equity finance their growth, but they were not profitable companies. And then I think the market started to falter, for whatever reason. And I think so much, people try to look at markets and think of them as very disciplined, fact-based, metrics-based. And at the end of the day, a lot of this is human psychology and human nature, right? People buy equity because other people bought equity. People buy stocks because they hear other people get rich buying stocks, right? And the problem with buying stocks when you hear other people got rich off a stock is you're very entering the market and buying it moves the stock up. But at a certain point, there just aren't enough people in the world to keep doing that. And eventually the fundamentals come back into play. And so I think what happened in early 2000 is that it became suddenly harder to get these companies public because the ones that had gone public before them were not showing improvement in their business models. And so people started to say, well, wait a minute, this isn't really working and these companies are just spending more money and where are the customers? And, there was a lack of continued belief that this was going to work. And, belief is an interesting thing in these nascent markets because when it turns the other way, right? And there's a term for that, right? It's called, particularly in technology companies, it's called the trough of disillusionment. And so you go through the hype cycle and then it turns out it's going to be much harder to do and take longer and people are not converting as quickly and the businesses aren't hitting the astronomical numbers and march to profitability they thought they were going to get to. And people enter the trough of disillusionment. And in the trough of disillusionment, if your company cannot make it through that, you will die. And you only make it through it by raising money or generating profit. And so once something starts going in the other direction, I remember a company, we took it public at $22 a share. On the first day of trading, it hit $60 a share. So just crazy, crazy, crazy. And a year later, it was at $2 a share. And that wasn't because of the fundamentals of the company. That was because of the market's perception of the company, because the company really wasn't that different in those three instances. And so, I think this is something that people just should be very aware of even today. I mean, I look at the market today and the companies that seem to be benefiting from COVID, for lack of a better way to put it, are seeing these astronomical valuations. And there are some companies, again, that have these astronomical valuations. I personally don't see how they're grounded in fact. But I could be wrong because, again, companies can exist for a long time and not be grounded in the economic facts. But as long as the market supports it until the time that the economic facts are there, then they end up being good investments.
Well, it's funny you mentioned that. You look at Zoom, which is 70 billion, and Tesla, which is 300 billion. It produces less than 2% of the world's cars, but is worth more than the top three automakers combined.
Right.
So looking at 2000, there's obviously Pets.com, which was a really big kind of a poster boy. What were some of the other big names that fell and that really represented that era?
Well, it's funny because you bring up Pets.com, which I remember well. It wasn't one of my investments, but it was the investment of a good friend of mine. And actually the CEO is a friend of mine too. And, you look today and there are a number of online pet supply stores that are doing very well, like Chewy. And then actually that CEO was a woman named Julie Wainwright, who went on to found The RealReal, which recently IPO'd and is a very successful current company. So she's a super great entrepreneur and successful CEO founder. So, there was Pets.com. Webvan was the really big one that burned through a ton of capital, and it was about home grocery delivery. Well, maybe they should have waited 20 years because it turns out that's a pretty good business right now. So I don't know. You asked me to remember. I think I've blocked it out of my mind after years of therapy because it was a very painful time to be in business. But, in general, I would say that there was for every sector, whether it was toys or diapers or whatever you could think of, there was probably a .com company started to prioritize being the online provider of that. And there are still a lot of those kind of companies around now, but they're designed for the current era and not for the era of 20 years ago.
So the bubble crashes, and by the end of 2002, about $5 trillion is wiped out from the stock market. This crash was accelerated by events like 9/11 and the accounting scandals of Enron, WorldCom, and Adelphia Communications, as well as an overall increasing rate of .com companies going bankrupt. After this, the impact on Silicon Valley was disproportionately larger compared to the rest of the US economy, as Heidi explains.
As I recall, it was a slower economy after that. I think the dot-com, it was interesting because the dot-com boom and bust was, while it affected the American economy, it most affected Silicon Valley. If I just think about the boom and bust of the dot-com era and what that did to real estate prices and traffic and, all the markers of rental prices, all the markers of whether an economy is booming or busting, it did have a pretty dramatic effect on Silicon Valley, I think much more so, though, than the rest of the U.S. economy.
Heidi, you were talking about how there were companies that weren't meeting their valuations or they weren't able to grow into it. I just quickly checked and, Netflix reported its earnings today, and it's one of these stay-at-home stocks because everyone is just binging Netflix right now, and that optimism increased the stock price by so much. But they're now down 10% after reporting an earnings miss. So it's such a timeless thing that you were saying with the idea of these companies that are just way ahead of their valuations. And as we can see with Netflix, just when they reported their earnings 20 minutes ago, I guess, they fell and they're down 10%.
Well, and again, these high flyers are going to all be very volatile. The volatility is going to drive you crazy if you don't understand volatility. And, when you're a venture capitalist, you hold for the long term. You're not a day trader. I mean, this is scary to me to see sort of the resurgence of the day trader, right? The person who's making their money buying and selling stocks. It's more like gambling. It's not based on the fundamentals. It's based on the movement of the stock in a very short period of time. And to me, that's just not that different from gambling. So to me, it's the buy and hold, right? When I go to invest in a company, I think about what are your long-term prospects, and I'll hold that position and I'll hold it for a long time. And, it's more the Warren Buffett way, right, than the day trader way. So I am a little concerned about what's going on in the market right now.
Looking forward after the dot-com bubble burst, some of the famous tech companies that we see today, like Amazon, Google, eBay, they made it out alive. Could you go more and elaborate what about those companies made them so resilient to all the market dynamics going on at that time?
I'll speak in the generic to all of them. I mean, I think they're all a different story, but fundamentally, they found business models that worked. And they had enough capital to sustain them through to the point of profitability. And that's basically a fundamental recipe for anything, right? Is do you make something that people are willing to pay more for than it costs you to make it? And can you build your company up to that point through, the equity you have to raise to do that? And as long as those two things are true, you'll make it out the other side. And, I look at the current situation. I think you will see some companies fail because there were certain business models predicated on a growing economy. And when that economy is not growing, some of those business models don't work. When people start spending less money because they're making less money, they start cutting certain spending habits that will be pervasive across, and things will die and go away. And so any entrepreneur today, you have to think about, the world isn't how you wish it could be or what it was like in January. The world is the world today, and it's probably going to be this way for a while. And so can you create a product that people are willing to pay more for it than it costs you? And can you fund yourself to get there? And so it really does boil down to some pretty simple basics for me. Now, that's not to say that you aren't going to see people make and lose money on some of these stocks that are going to be very volatile in this time. Because one thing about volatility is, on any given day, there's the opportunity to make or lose a lot of money depending on what side of that you are on, even if at the end of the day, the fundamentals aren't any different.
I want to ask you, there's this quote by a venture capitalist, Fred Wilson, in his book where he said that nothing important has ever been built without irrational exuberance. Could you elaborate more on whether or not a dot-com bubble or something like that is necessary for laying the groundwork for future innovation to come?
Well, I don't think it is, because I think at the end of the day, it's not about booms or busts or dot-com bubbles or anything. It's about classes of investment risk and investors willing to go into those classes. And so certainly times are easier and harder. But after the dot-com bust, all the VCs in Silicon Valley didn't go, well, gosh, I guess we shouldn't invest in technology anymore. That's a bad idea. Let's all go home. The dynamics of the entry and exit prices changed, but the fundamental ability to create huge valuation disruptive companies didn't change. And so I don't think you need these boom and bust cycles. I think boom and bust cycles are inevitable. Again, I think it's partially human nature, and I think it's partially other exogenous things. And so I don't think you can avoid them. But I think that you can continue to, as our firm does, we are continuing to invest. We've made 3 new investments since the lockdown. And you continue to believe in the long run, right? And so take a company like we talked about earlier, Memphis Meats, right? Memphis Meats raised about 170 million in January of this year. So in a way, we were lucky that we did it before the lockdown. Things are a little more complicated. But at the end of the day, Memphis Meats is not going to ship a low-cost meat product for a number of years still. And so the gyrations of the equity market in this interim period are almost irrelevant to a company like Memphis Meats, right? Now, someday we need to exit that company because that's how we pay back our limited partners. And so we are going to be reliant on either a capital market or an M&A market that is going to value Memphis Meats at some point, call it 6-7 years from now, when we kind of need to exit our position. And so then it's going to matter more to us. But at the end of the day, if it's a successful company and it's generating revenue, profit, and growth, it will be valued by the market. Cycles aside, companies that perform solidly on fundamental business metrics will have value.
Heidi emphasized here that tech and internet companies that were truly going to deliver on their promises would have done so regardless of the huge dot-com bubble bursting and market cycles in general. Instead, the companies that made it through the dot-com bubble focused on staying funded and being profitable. Emerging and looking back at the dot-com bubble, one would imagine that venture capitalists and other investors would become smarter and invest more intelligently and begin taking companies' performance on fundamental metrics like revenue and profits more seriously. But when I asked Heidi whether or not she thought VCs have become smarter in the years after the dot-com bubble, here's the surprising answer she gave.
I would never say that. Remember, it's not like there was one VC and they went through this. And I'll put in a plug for Threshold. I think one of the advantages of Threshold is we have a lot of diversity on our team, including age diversity. So we have partners in their 60s, 50s, 40s, 30s, and 20s. And so we have people that operate in different networks. We have different experience sets. We have different memories of things that happen. And so those of us who were VCs during the dot-com bust have some scar tissue that we can share with the younger partners who haven't been through those cycles before. But I would not say that all of a sudden the whole world got smart. I would say that, yes, there's irrational exuberance. There is also the idea that some people have more vision in certain sectors than other people. There's a lot of luck involved in this. Yes, there's a lot of hard work and understanding where the market is moving and understanding underlying technologies. But there is also once in a while, you pick the right one and it works out well. And so, I think leading up to now, again, I don't want to pick on an individual company, but I'll pick one that's easy to pick on. WeWork's valuation a year ago at this time isn't what WeWork's valuation is today. How much of that is the market and how much of that is it wasn't a very good business model?
Right. So if you were to summarize the main lessons, any kind of investor, old and young, professional and beginners, if you were to sort of summarize a lesson or a series of lessons that you would give based on the dot-com bubble to those kinds of investors, what would those lessons be?
I really want to say buy low, sell high. But to a certain extent, that is true. To me, it is when you're in my business, you need to invest for the long term, and you need to understand how those businesses are ultimately going to become valuable businesses by their ability to generate revenue, profit, and growth. And that could take a long time. That could require a lot of technology. It can require a lot of luck. Betting on something super early like Zoox and autonomous vehicles or like Memphis Meats and cell-based meat, you don't know that yours is going to be the winner. You don't know sometimes how long it's going to take to get there, but you do know if you pick a big enough TAM, total available market, if you happen to be the company that sort of nails that first, there is a super, super big market for you. And you've got to get the economics right. And at the end of the day, I don't count on markets to create my returns. I count on the company to create the return. And if I get lucky because it's a super hot market, well, that's great. And if I get unlucky because the market's not as hot, well, if the company is a really solid company and it's performing well, we will find a way to exit with value.
Yeah, and I think that a lot of the tenets of any kind of buy and hold investing is really ignore what Mr. Market says. And it's just really focusing on having the company create value. We're going to begin our ending questions now. So, Alex, you want to ask the first one?
Yeah, well, Heidi, it's great that you're on because you're really piloting some of the great programs that kind of integrate VC and entrepreneurship, which are kind of newer industries within education and higher education. So do you mind telling us a little bit about the Threshold Venture Fellows program that you run?
Sure. I'm super happy to talk about it. So we started this program now. I think we're just about to enter our 7th year at Stanford. It's for master's students in the hard sciences. It's a highly competitive program. We usually have about 70, 80 applicants for 12 spots. And, the idea behind it was really that there's a lot of classes at Stanford that I'll call there's startup classes that are PowerPoints and spreadsheets, right? Teaching you, and nothing wrong with those, right? I mean, a lot of the work that helps people understand how to form and build companies, they play an important role in the startup ecosystem that I think has really defined Silicon Valley for a long time. And I think Stanford is a big part of that. But we're really trying to help people understand, I would call it the ethos of entrepreneurship, the idea of how do I think about being an entrepreneur as an individual? How do I think about the sacrifices I'm going to make? How do I think about how hard it's going to be? How do I think about my impact on humanity if I should be so fortunate as to build a foundational company? What about my ethics? What about the choices I make? What are the implications of my technology? And how do I deal with failure? And how do I survive as a human being? And how do I be a good human being through the process? We're people first and we're our jobs second. So it really is a kind of a journey through, as I call it, the ethos of entrepreneurship.
It sounds like an incredible program. And I think, you start to see a lot of entrepreneurship being introduced to the younger generation, at least undergrad students, master's students. I know MBA programs are changing pretty rapidly to adapt to tech and entrepreneurship. Someone Rohan and I know, Kasha, he started like a scouting program through Draper Associates that reaches out to university students. So is this industry really looking towards, I guess, a younger age range? And is that something that's going to be good looking into the future?
Well, I think there's always, look, like I said, one of the things I like about our firm is we have age diversity. And one nice thing about age diversity is just you have people that are different places in their lives. And people who are also just open to different technology and different ways of doing things and have a different, I didn't grow up with technology because it wasn't available at the time I was growing up. And so technology for me will always be a second language in the way that it's more a native language to people much younger than I am. On the other hand, I've had a lot of experience that, like I said, I think our younger partners benefit from that because they can learn from my mistakes and learn from my experience. And so I think as a team, we make a very strong team because of that. And so I don't think that entrepreneurship is a young person only game. I think that the spirit of entrepreneurship, and I actually used to teach a class at Stanford, it's still taught there, I don't teach it anymore, called the spirit of entrepreneurship, is how do I use my own ability to create something out of nothing? And that doesn't need to be business formation necessarily. It can be around a nonprofit. It can be around, inside a company. It can be around, your own passions or your family or whatever it is. I think the entrepreneurial spirit is around that idea of I'm going to use my own energy and resources and hopefully command the energy and resources of others to create something that didn't exist before, to grow the pie, to make things bigger, to make things better. And so I think that that is something that can be taught. You can teach people how to think through these things. While some people are more innately entrepreneurial than others, perhaps, I still think that most people you can learn entrepreneurial skill sets to know how to ideate, test things, meet with customers, prototype. There's all sorts of things you learn in some of the, what I would call the more prescriptive classes around this that apply to everyone. I don't think you're ever too young to be an entrepreneur, and I don't think you're ever too old to be an entrepreneur. But I do also believe that people need teams, and they need those teams to be diverse. Nature has taught us that diversity leads to strength.
So, Heidi, this is a podcast that is mainly geared towards educating students about finance. So this is the question I ask all my guests. What did you teach your kids about tech and finance and investing and money management when they were younger? And would you give the same advice to other students?
I think my kids would tell you that I probably didn't spend as much time teaching them about tech and finance and all of that. My kids are now 25 and 27, and I probably talk to them more about that now than I used to. But I think if I taught my kids one thing more as a model of this behavior, it's take responsibility and work really hard. And I've always believed in being a person who I take responsibility for my life. I take responsibility for my work product. I try to make it a really good product, and I try to work really hard. And I try to do business with people who share my ethics and values and, leave the world a better off place than when I started. So I think those are kind of the fundamentals that I think my kids picked up through whether direct conversation or just osmosis from being around. And I still believe those things to this day.
Yeah, and it's advice I will be sure to follow as well. Heidi, thanks so much for being on this podcast, and we hope to have you on in the future.
Well, thank you for having me.
So Alex, that was a fascinating conversation. What were some of the key takeaways you got from it?
I think one key takeaway was that the dot-com bubble wasn't the fault of a single person or single institution, but rather the whole ecosystem of entrepreneurs, evangelists, venture capitalists, Wall Street, and bigger tech companies. Ultimately, the hype and irrational generosity afforded to those entrepreneurs who wanted to do something with the internet made this bubble.
Yeah, those companies just prioritized growth over profits and didn't focus on finding a viable business model. Lots of them just prioritized getting as much funding as possible from VCs and from IPOs rather than prioritizing ways to sustain their business. There was a lot of evangelism, which isn't necessarily a bad thing. But when that evangelism and subsequent hype drives up optimism and valuations to a point where companies cannot deliver what they promise, then we have a problem and the bubble bursts.
She also made sure to emphasize that the companies that ultimately made it through the dot-com bubble, Amazon, Google, and others, those companies were the ones that focused on creating true value for investors and their customers by focusing on finding a business model that could sustain it. And those who invested in these companies and held throughout the worst of times have profited quite nicely.
Exactly right, Alex. And if you're not someone who deals with derivatives like options, then the implication for normal investors in stocks and bonds is really just to buy and hold for the long run and ignore the day-to-day swings in investor psychology. And I was pretty surprised when she had said that she doesn't think VCs or investors have gotten smarter in their due diligence or in their overall intelligence after they experienced the dot-com bubble. While VCs like Heidi and others who invested during that time now have, as she said, scar tissue and can pass on that knowledge to younger investors, the fact remains that VCs and other investors are just as likely to invest the same way they did in the late 90s today.
They may appear to have gotten more intelligent in how they analyze investments, but I think Heidi's main point was that no matter what, the same forces that caused the hype and irrational exuberance in the late 90s can cause investors today to make the same mistakes, and many still are making those same mistakes.
I think the lesson here is to make sure that you are always analyzing your emotions and bias towards the market and opportunities. Do you find yourself speculating more than actually paying attention to established facts? Do you see promises of innovation that seem too good to be true, given the current realities? Do you see that people are investing for the purposes of a quick profit more than investors who are buying and holding on for the long term? The answers to these questions are clear when fitting them to the dot-com bubble. But if you ask those questions today, you may be surprised or even worried by the answers you find.
This is especially important for beginning investors to understand. The dot-com bubble seems to have been the norm, not the exception, for investors and humans in general, and their tendencies to get caught up in excessive hype, irrationality, greed, FOMO, and speculation.
I definitely agree. Well, Alex, thanks for being the co-host today. You were amazing for your first time.
Thanks for having me as a co-host, Rohan. I'll be back for more in the future.
Hey guys, I want to thank you so much for listening to this episode of the podcast. It truly means the world to us. If you like this episode and others, let us know by subscribing and giving us 5 stars on Apple Podcasts and following us on Spotify. Share us with your friends and check us out on Instagram and Twitter, both at StreetFins. You can also follow me on Twitter at RohanInvest. If you'd like to get in touch with us, please email fspodcast@streetfins.com. Thanks once again to Heidi Roizen for her insights today. I hope you understand the topic of the dot-com bubble in a more simplified way. You can check her out on Twitter at Heidi Roizen and visit her website, HeidiRoizen.com. Links in the description. Once again, we're really happy that you're taking the initiative to learn finance and to better your future. If you haven't already, we highly encourage you to check out streetfins.com for articles, videos, and other content. Join the StreetFins community and tell your friends about us so that they can learn about finance too. We'll talk to you next time on Finance Simplified.